This is Nightly Business Report with Bill Griffith and Sue Herrera.
Steady as she goes, the Fed signals it may not make any moves on interest rates this year, cutting its forecast from 2 hikes to none.
Antitrust fine. The European Union goes after Google, just the latest regulator to turn up the heat on big tech. Is this the price they pay for success?
Done deal. Disney closes its blockbuster $71 billion purchase of Fox. And now the hard work begins. Those stories and more tonight on Nightly Business Report for Wednesday, March 20th.
And we do bid you a good evening, everybody, and welcome. So it was decision day for the Federal Reserve with a twist. As expected, the central bank kept its benchmark interest rate unchanged. What was not expected was a strong signal then that there will be no rate increases this year and maybe only one next year. Investors breathed a sigh of relief immediately after that announcement was made. The Dow recovered from a 200-point decline. But words from President Trump today that U.S. tariffs against China may remain in place for a prolonged period, that took a toll. And by the close, the Dow was down 141 points. It closed to 25,745. NASDAQ was still up 5 points. The S&P was down 8. Steve Leisman has more on the Fed's decision from Washington for us tonight.
The Federal Reserve, in a series of major announcements after its March meeting, kept interest rates on hold, downgraded its economic outlook, and forecast no rate hikes in 2019. The meeting of members of the committee had previously forecast 2 hikes this year. They're gone now. The Fed also decided to stop reducing its balance sheet, which some in the market had said was hurting the economy, and that would begin in September. For a central bank that moves policy slowly, it was a rapid about-face for forecasts of strong growth and a rate hike as recently as December. Despite the changes, Fed Chairman Jerome Powell maintained a positive outlook.
The data are not currently sending a signal that we need to move in one direction for another. Committee members, participants generally see growth of around 2%. They see unemployment remaining below 4%. They see inflation remaining close to target, and they see growth, as I said, around 2%. So, that's a positive outlook. It's a favorable outlook.
Still, the Fed downgraded its outlook for growth from 2.3% to 2.1% this year, and Powell highlighted risks to the economy coming in part from global developments.
You see slowing global growth. You still haven't. There's no resolution of Brexit. There's no resolution really of the trade talks. These are ongoing risks. We're also carefully monitoring what's happening with U.S. growth. We called that out in our statement. The limited data that we have do show a slowdown. On the other hand, as I mentioned, we see the underlying economic fundamentals for growth this year as still very positive.
Finally, Powell noted that downward pressure on inflation is a major challenge for the Fed and central banks around the world. But overall, no hint from Powell about what the next move is, up or down, and he gave the clear impression today he doesn't know either. For Nightly Business Report, I'm Steve Leisman in Washington.
Let's turn now to Art Hogan for more analysis on the Fed, the economy, and the market. He is Chief Market Strategist at National Securities. Welcome back, Art.
Hey, Sue, thanks so much for having me.
You say this is a bold move. I guess the question is, in your opinion, was it the right move?
Well, it's hard to say. It's interesting. The 3 things I think about here is I really feel like Jay Powell didn't need to actually remove both of the dots for 2019. Plenty more meetings in front of him that he could have done that. So that's where it really gets bold. So that exceeded expectations. But, this is truly a Fed that has made a pivot in January from being autopilot hawkish in December to patient in January. Now they're even more patient. So what does that tell us? It tells us that this Fed is actually at neutral. They're literally at neutral, and the next move could either be a hike or a cut in interest rates. My guess is the next move is a hike, and I think that probably comes in the first part of 2020. But right now, the Fed has reinforced the fact that they're really patient, and that's probably a tailwind for the market.
So what does the stock market do with that? Clearly, for Wall Street, no more hikes, at least for the foreseeable future. That's a good thing. But they also then downgrade their forecast on the economy. That's not such a good thing. So where does the stock market go, do you think?
Right. And I think you really would rather have the Fed tightening than cutting rates as their next move, and that would mean the economic activity had picked back up. So, we know the first quarter is likely going to be slower than the fourth quarter of last year. We hope that the second quarter picks up in activity. We don't know that yet. And I think what Jay Powell was speaking to was that oh, by the way, the global economy has slowed down, and we have no resolution on both Brexit and the U.S.-China trade war. So I think when we think about all of those things, if any of those things turn positive, for example, if we get a U.S.-China trade deal, I think the economy picks up in the second and third quarter of this year. It's just a function of when that timing comes. So the Fed may well have to hike again. It may happen this year, but it's just not in the cards.
So as you look at the market as an investor, a longer-term investor, how do you handicap this, given the headline risk that you just outlined?
Well, we need to get trade behind us to think that we can earn $170 for the S&P 500 this year. That's what our base case assumption is. And if we don't do that, and if we escalate, then I certainly think that this market is pricey. Our base case is we're going to get a trade deal done. Unfortunately, we're going through that back and forth process right now, which seems like it's at the end of the process, not the beginning. But I think that getting a trade deal behind us, we think this market can actually move higher than we are right now. We just need to get that in the rearview mirror.
All right, Art, we'll leave it there. Thank you. Art
you.
Hogan with National Securities. European Union officials say they are willing to grant a short delay for Britain's exit from the bloc, but that delay comes with conditions. They want Parliament to approve the withdrawal plan that has already been rejected. That increases uncertainty just days before the UK is scheduled to leave the EU on March 29th.
And the European Union has ordered Google to pay $1.7 billion for antitrust violations. This is its third fine in a series of penalties. The EU's competition commissioner says Google abused its position in the online advertising market.
If you have a travel website or a news website and you want to sell the advertising space next to the search that you can do on your site, you need a broker. And Google is one of the absolute biggest brokers in this market, and they misused their dominant position to make sure that no rivals were able to compete in this market for search advertising on news sites, on travel sites.
In response, Google's parent Alphabet said today that it has already made changes to its products and that it plans to make additional updates as well.
The tech giant and others in the industry are also coming under pressure here in the U.S. So what does that mean for the tech industry? Ian Scher is executive editor at CNET. He joins us now to talk about that. Ian, welcome. Nice to have you here. It seems as though Europe is taking the lead on all the talk about regulation of big tech and also possible breakup of big tech. What do you think is going to play out on this country's soil?
You know, it's going to be really interesting. I think there's going to be an ongoing conversation on Capitol Hill where they try to understand the basics of how technology works. We've learned that they have a lot of education to go through. And I think at some point there's going to be a test, whether it's an attempt to really see what a breakup of Google or Facebook could look like, and then see what happens to the rest of the tech industry. But there's going to be a lot of pushback, especially from the tech industry, who says, look, we're getting all of this pressure and we don't deserve it.
Here it has happened again. It's happened in the past. Technology companies or companies on the cutting edge of some type of innovation get way out ahead of regulators and lawmakers. It happened with AT&T. It happened with Microsoft. And now it's happening with a lot of these FANG stocks. What's your expectation, not just for what the regulators and lawmakers are going to do, but what the companies, how they will respond?
Well, they need to get in front of this as much as they can, right? There's a lot of things that have been put out there. I think that Senator Elizabeth Warren, who's now a presidential candidate, has caused a lot of conversation that probably would not have happened otherwise or taken a little longer by calling for a breakup of Amazon and Apple and Google and Facebook.
But are there regulations or self-regulations that these companies can come up with that would give them some space between the regulators and the lawmakers so that they sort of tone down the rhetoric?
They could answer a lot of these concerns. I mean, the thing is that right now, these companies are getting a lot of pressure from all sorts of places, and they're kind of responding to some of it, but the larger problems still remain. You know, we're still not convinced that the election interference that happened in 2016 won't repeat. We're still not convinced that these companies are not acting monopolistically, and there's still ongoing concerns that they are not protecting our data correctly. And if they can't answer all of those types of questions, they're going to have a bad day at some point.
Yeah, very quickly in the 30 seconds that we have left, if indeed it came to the ultimate solution, which would be perhaps a breakup, wouldn't that foster perhaps more innovation? We have seen that in the past as well.
that's definitely an argument. And I think that's where you're starting to see people like Senator Warren push toward. But that's not a guarantee. If we just break them up for the sake of breaking them up, we're causing trouble in the economy. We're not actually being thoughtful. And that's what's really important. We need to be thoughtful if we're ever going to go down that path.
All right, Ian Scherer with CNET. Thanks so much.
My pleasure.
So with all the talk about regulations and laws to rein in some of these tech giants, is Wall Street's so-called FANG era coming to an end? And if so, where does new leadership come from? Mike Santoli is staying late for us tonight at the New York Stock Exchange to explore that. And you actually don't buy the notion that the FANG era is coming to a close.
Well, I do, Bill, think it's a little bit premature to say it's coming to a close. What we have seen, though, is a little bit of a fracturing of FANG. What I mean by that is if you looked at Facebook and to a lesser degree Google's parent Alphabet, those stocks underperformed for a lot of last year. Facebook has had its valuation punished to some degree because of all these concerns. But at the same time, Amazon, Netflix, these companies that are not really using your private data in a way to sell to advertisers, but are selling a service that you are purchasing of your own free will and you wish to, they have actually performed better. So there's definitely been some rethinking about exactly how durable some of these business models are.
All right, so if indeed we do see action against some of these companies or regulations, where do you see new leadership kind of emerging?
You know, so it's very difficult to conceive of new leadership that is exactly as dominant as these companies, because I do think there's an argument to be made that these businesses are, in some sense, they tend toward natural monopolies. They have these network effects that gives them power. But I think you would probably, if these did get broken up or really recede in the market's favor, probably healthcare is the place to look, whether it's medical technology or healthcare services. You've already seen it grow to a larger portion of the overall market value for the S&P 500. So perhaps that is the way to go. But, you know, we've gone long stretches of time in the market without a single dominant cohort of companies that was really driving return.
But going back to the FANGs for a moment here, you have to admit that if there are to be regulations or some kind of a law, even if there's a breakup, that is going to put a crimp on their profitability going forward, isn't it?
No, I would completely agree with that. And not only overt regulations or breakups or lawsuits, but also just the chilling effect that it has on these companies' ambitions down the road, right? Every one of these technology companies probably figures it has to maneuver for its next act, expand it to new businesses, whether it's self-driving cars or some other services. And are they going to be permitted, for example, to make additional acquisitions the way Facebook has done so well over the years? Or are they going to expand into those other areas aggressively? Or will they be thwarted? Those things, I think, very long term should be on investors' radar as just exactly how open-ended are the growth prospects for a lot of these companies.
Mike Santoli at the New York Stock Exchange. Thanks, Michael.
Okay, thank you.
It is time to take a look at some of today's upgrades and downgrades. FedEx was downgraded to neutral from overweight at JP Morgan. The firm cites rising labor costs and potential pressure on operating margins. As we reported, the company cut its full-year profit outlook late yesterday. The price target is $202. The stock fell about 3.5% to $175.07. Sony was downgraded to hold from buy at Jefferies. The analyst cites concerns about a peak in game profits and Sony's inability to exit the smartphone business. The price target is $50.70. The stock fell almost 5% to $43.28. And Dollar Tree was upgraded to outperform from market perform at Telsey Advisory Group. The analyst there cites a recent meeting with management, which increased his confidence in the company's plan. The price target is $117. Shares rose a fraction to $101.35.
And still ahead, an idled auto plant and the hometown feeling the impact.
This shrine of hope has been built outside this now closed GM plant that has President Trump tweeting. I'm Frank Holland. I'll have local reaction to those tweets and the closure coming up on Nightly Business Report.
There are reports tonight that the FBI has now joined the criminal investigation into the certification process of the Boeing 737 MAX. As first reported by the Seattle Times, The FBI's Seattle field office is now part of this investigation because of its close proximity to Boeing's 737 manufacturing plant in Renton. The investigation is being overseen by the Justice Department and carried out by the Transportation Department's Inspector General. This latest report sent Boeing stock initially lower in after-hours trading tonight.
Oil prices settled at a 4-month high after hitting $60 for the first time since November. Government data showed a sharp decline in oil and refined fuel inventories. That sent the price of domestic crude higher, though it settled just below that $60 level.
Optimism among the nation's CEOs is cooling off. According to the latest survey from the Business Roundtable, chief executives are concerned about global economic growth. CEOs now see the economy growing at 2.5%. That would be this year, and it's slightly down from the earlier estimate.
The Disney and Fox merger is officially complete, and it could mark the beginning of a new era for Hollywood. But integrating the two companies could prove challenging. Julia Borston explains.
Disney has officially acquired Fox's entertainment assets, including its movie and TV studio with its Avatar and X-Men franchises, along with its National Geographic and FX, plus Indian media giant Star, and an additional 30% stake in Hulu. These assets building Disney into a behemoth with more content to stream direct to consumers to enable it to better compete with digital giants such as Netflix.
It's kind of a roll of the dice to see who's going to come out. It's going to, for everything to go seamless and everyone to be a winner, that's probably a little bit unrealistic. And we've seen Netflix, what they've done over years is spend, spend, spend. I mean, I think Disney and the likes of some of the other players are going to find out to compete with Netflix. It's going to ding their profitability.
Iger writing in a note to employees today, "I wish I could tell you that the hardest part is behind us, that closing the deal was the finish line rather than just the next milestone. What lies ahead is the challenging work." The challenge that lies ahead isn't just about integrating the two companies, but about the launch of Disney's direct-to-consumer streaming service, Disney Plus, later this year. It's expected to include new original exclusive content, plus Disney's library. Disney will unveil the details of the new service, which will feature its major brands, such as Star Wars and Fox's National Geographic, at a preview day next month.
It remains to be seen if Gen Z and millennials actually want to download something called Disney Plus. Does that remind them of their childhood? Do they like the idea of something more edgy, which is definitely what Netflix provides?
As Disney doubles down on on-demand content, the remainder of Fox is focused on live news and sports, spinning off to trade as an independent company, focusing on its ability to drive ad revenue and cable retransmission fees for its timely content, looking to benefit from the political news cycle, in sharp contrast to Disney's more timeless content. For Nightly Business Report, I'm Julia Borston.
The FDA approves the first postpartum depression drug. That's where we begin tonight's market focus. Sage Therapeutics is the company that made the injectable drug called Zulresso that treats this condition. It will only be available through a restricted program because there are concerns about risks, including excessive sedation or sudden loss of consciousness. 2 clinical studies, though, showed improved symptoms at the end of the first infusion, and the CEO says that is key.
When you think about what we potentially are offering, rapid response, one-time therapy, getting women back home, we don't hear any resistance to that. In fact, there's a lot of enthusiasm in order for these women not to suffer in silence, but to get better.
Wall Street's been anticipating this. The stock's been up 60% so far this year, but it ended the day down more than 2.5% to 152.46. General Mills increased prices, and it paid off. The packaged food maker today reported higher margins, better than expected earnings, and it is now forecasting improved profits for this fiscal year. The company was also helped by lower costs. Shares rose about 2% today to 48.29.
Nexstar will sell 19 TV stations for more than $1 billion to Tenga and Scripps. The divestitures follow the acquisition of Tribune Media by Nexstar, which said it is in talks to sell 2 more stations in Indianapolis. All 3 stocks fell. Nexstar was off a fraction. Tenga and EW Scripps were down close to 3% each. Ford plans to build a new factory in Michigan for autonomous vehicles. The new facility is expected to open in the next 2 years. The move is part of the automaker's plan to focus on its future lineup of self-driving and electric cars. The stock fell 2% to $8.51.
President Trump traveled to Ohio today, just days after pressuring General Motors to reopen a plant in that state. The automaker's factory closed earlier this month, and the town of Lordstown is feeling the impact. Here's Frank Holland.
Outside of this now closed factory where General Motors made the Chevy Cruze, a shrine of hope left by some of the thousands of workers who made their living here.
You just don't replace these jobs.
Ryan McCabe, a husband and father of 6, was laid off from the Lordstown, Ohio plant after 19 years.
Your family has worked at General Motors, your family's retired from General Motors, and you're the last one there, and then all of a sudden it's all gone.
GM closing this factory as it focuses more on trucks and SUVs. Sales of the Cruze sedan falling by almost half over the past 5 years. McCabe took these pictures of the last Cruze leaving the assembly line. Now he and thousands of other workers are searching for jobs at other GM factories.
When General Motors and Mary Barra tells us that there's all these opportunities for us to transfer, it comes across as so cold and calculated, because I know they have kids, I know they have families, and how would they react in the same situation as us?
Lordstown is under reallocation and could reopen after September when GM and the union enter contract negotiations. But President Trump, who visited Ohio today, wants answers now, tweeting over the weekend, "I want jobs to stay in the USA and want Lordstown, in one of the best economies in our history, opened or sold to a company who will open it up fast."
I'm glad he is supporting us and wants to help us. I just wish he would come here and kind of see firsthand instead of just making random tweets about it.
The reaction from others in town is mixed, especially after a 2017 speech where the president told local workers manufacturing jobs would be coming back.
I think it's a little too late. I think he should have been on the bandwagon when they cut the other shifts and when they announced that they were going to cut this shift.
I feel like it's the company's fault, not the president's fault.
The closure of this plant is expected to have a $3 billion negative impact on this region this year. But at the same time, manufacturing jobs here in Ohio have grown more than 2.5% since January of 2017. Still, the fate of this factory and McCabe remains unclear.
We don't know if this is a temporary layoff or a permanent layoff. The whole unallocated status just kind of makes it hard to gauge what to do, especially for people with families.
For Nightly Business Report, Frank Holland in Lordstown, Ohio.
Coming up, companies are looking for the next big thing in gaming, but are consumers willing to pay up?
There was a legal setback for German life sciences giant Bayer last night. A second jury has ruled now that its Roundup weed killer caused a man's cancer. Bayer denies the allegations, saying it was disappointed with the decision, but Bayer did acquire Monsanto, which makes Roundup for $63 billion last year.
We told you yesterday about Google's big push into the growing video game market. Today, other companies showed off their new innovative devices that they hope will be the next big thing in gaming. Josh Lipton is in San Francisco tonight.
Great. If you move your body around, that's perfect.
Some fans don't just want to play video games, they want to feel like they're inside the game itself. That's the appeal of virtual reality, or VR, a totally immersive 360-degree experience. Today, here at the Game Developers Conference in San Francisco, one of the biggest players, Facebook-owned Oculus, introduced the Oculus Rift S.
Rift S over Rift features a much higher resolution display, which obviously makes the whole image a lot clearer and more immersive. It also features our Oculus Touch controllers, which give you a natural sense of real hand presence, being able to reach out and interact with the virtual world around you.
It's not just the big companies. Startup Magic Leap sells so-called mixed reality goggles where the digital content is integrated into the real world. For example, when I put on the goggles, I suddenly appeared like an old man to my fellow gamers as we ran around the room and took shots at each other. But for all the hype, this remains a relatively small market for now. Analysts say only 6% of U.S. gamers own a virtual reality or augmented reality headset. In part, they say that's because there still isn't enough compelling content right now to motivate a lot of gamers to go out and buy this hardware. And that's partly because of the rising popularity of games that are free to play, like Fortnite, made by Epic Games. It boasts more than 200 million registered players, raking in almost $2.5 billion last year. Electronic Arts released rival game Apex Legends in early February. 50 million players signed up for that game in the title's first month. Analysts are watching Electronic Arts closely. If Apex Legends is a success, then other publishers, such as Activision, may follow suit and more enthusiastically embrace that same free-to-play battle royale style. For Nightly Business Report, I'm Josh Lipton, San Francisco.
Finally tonight, it's time for March Madness. According to the American Gaming Association, nearly 50 million Americans are going to wager a collective $8.5 billion on the college basketball tournament. This is the first March Madness, by the way, since the Supreme Court overturned that ruling that effectively outlawed sports betting in almost every state.
Here's a look at the final numbers on Wall Street. The Dow fell 141 points. NASDAQ rose 5. S&P 500 down 8. That'll do it for Nightly Business Report tonight. I'm Sue Herrera. Thanks for joining us.
I'm Bill Griffith. Have a great evening. We'll see you tomorrow.